Hello, welcome everyone. My name is Shiraz. I'm a broker at Suits Realty here in New York City. I run a real estate brokerage firm. We help our clients buy, sell, rent their real estate property. So if you're looking for a brokerage firm, an agent that's going to be on your side, whether you're buying, selling, or renting, make sure you reach out to us. I'll leave the information down below in the description. Let's get into it. This is going to be a new series that I'm going to be doing every Friday. I'll come live or pre-recorded video. It's going to be called Financial Fridays. It'll give you a recap for the last 7 days, where the market is, the top news in the market, what happened, whether it might be the stock market, the bond market, the mortgage industry, in the real estate, what's happening. You'll get it Friday in your inbox. So make sure. Which was the biggest news that happened this week, which was the Fed. The Fed decided to hold the rate steady. So after 3 cuts in 2025, they decided this year we're going to start 2026 off with no rate cut whatsoever. So they're going to hold off for now. Let's go over some of the information, what they talked about within the meeting. And we actually have a little bit of a breakdown here. I'll start with this. So Fed holds key interest rates steady as economic view improves. So they did say that based off of inflation, unemployment, and as well as the economy, they covered all 3 topics. And they said that this is their views on it, and I'll go over it in a few minutes.
Pausing after 3 consecutive cuts, maintaining the rate of 3.5 to 3.75. There were, however, 2 dissents, Governors Waller and Myron, both dissenting, favoring a 1/4 point cut this time. They kept the language that they used last time to signal a pause, saying that in considering the extent and timing of additional adjustments to the target range, that was what signaled a pause last time, perhaps telegraphing a future pause. There was also a noticeable upgrade to the economy and something of an upgrade to jobs. On the economy, they said it expanded at a solid pace, really marking to market what we know out there in terms of what's been happening with GDP. It had said the economy was expanding at a moderate pace. Job gains, they say, have remained low, but they say unemployment has shown some signs of stabilization. Last time they said it had edged up. They also removed some language that said downside risks to employment have risen. That's gone from the statement. They removed language saying there's been a shift in the balance of risks. That balance of risk was towards downside risk to employment. That's gone right now too. Inflation, they said, remains somewhat elevated, removing the language that said it has moved up. New voters, Hammock, Logan, Kashkari, and Paulson. I want to say the statement overall suggests the heat has kind of cooled down on both sides of the mandate for the Fed. A little bit more relaxed about inflation, though they're saying it's still elevated. More relaxed on employment, removing that downside risk concern. And just a little bit of trivia here. I'm pretty sure this is right. We're second time in 6 months that 2 governors have dissented, Waller and Bowman in July, now Waller and Myron this time around, though the dissent now is for a 1/4, not a 50. Perhaps that's a little bit of coming together. The last time before this past 6 months we had that, guys, was 1993. So still quite a bit of disagreement on the Federal Reserve Market Committee, though perhaps not exactly as much as we've had in the past. Kelly?
Okay, now what does this all mean? So basically what the Fed decided was, well, after they had their vote, they decided, you know what, we don't know. To me, my understanding is they don't understand where the economy is headed. They still don't have a full grasp on how the tariffs are affecting the market, how the consumer spending and behavior is changing. So they just boiled it down to this. Economy, they said, is still growing solid. The tariffs have not impacted the economy in a significant way where it's going to lower the GDP. The GDP is actually growing in the U.S. The job market is slowed, but it's stabilizing. The job growth is stabilizing, and inflation is still high, but they remain on their target at 2%, and they said that that's what they're going to work on. And as they work on towards that 2% is when they'll decide to lower rates again. So as of now, based off of those 3 topics, the jobs market, economy, and as well as the inflation, the Fed decided and voted that we're going to hold the rates steady. So right between 3.5 and 3.75%. Now, remember, guys, that doesn't mean that that's the rate that you're going to get on your end for car loans, credit cards, personal loans, any other type of loan, mortgage or anything like that. That's just the rate, the overnight rate that the banks borrow from the federal government. And then the banks will then put their premium on it, and then pass it on to the consumer. And then that's what you see on your end. So it does directly, it doesn't directly affect the consumer. But if the Fed was to lower their rates more, then you can potentially see lower rates in the auto industry, in the mortgage industry, and all around wherever lending happens. So that's where we are with interest rates. They're going to hold it steady. And the next Fed meeting is going to be in March. I'm assuming that they're not going to cut the rates again. I believe they're just going to hold it off until June. Also know that Jerome Powell, the Fed chairman, this is coming to an end. We know he's not going to remain as the Fed chairman after June. So he's going to be out. There's going to be a new person in. And then it's, time will tell what's going to happen between, is the Trump administration going to be able to influence, their wanting or their need to lower rates even more on the new chairman, because clearly they can't influence on Jerome. He's been fighting back, since Trump took office, and he cut the rate. Even though he cut the rate 3 times last year, it was still not where the Trump administration wanted the rates to be. They want them to be super low at 1%. So let's see what happens going into the future. But I think in March, I don't think they're going to cut the rates again. I think they're going to hold it. And let me show you where today's mortgage rates we ended this week. Let me bring the chart up right here for you. Okay, so 30-year fixed, we ended at 6.16%. 15-year is at 5.75%. And the FHA loans are at 5.79%. This is kind of amazing because these are much, much lower rates than they were just a year ago and 2 years ago, and these are at the lowest within 3 years time period. So if you're in contract right now, you're looking to get a mortgage, I think this might be the time. Come Monday, Tuesday, lock in your rate, and see, work with your loan officer and see what a good decision is for you, whether you buy points or not, in order to lock your rates in. However, 6.16, 5.79 for FHA, I mean, this is a good rate. And we've seen that when the rates get closer to 6%, especially as a real estate broker with all the transactions that we're part of, as we see that buyers are more intrigued and they enter the market and they get more excited, and you have more buyers on the market at 6% or below. That's like the trigger point right now for a lot of buyers. And that's usually the case every time you hit like every 0.5%, you get a new wave of buyers and sellers entering the market at that point. But 6%, we've seen a big increase in buyers coming back to the market, starting to shop around, get their pre-approvals, and look for homes. And we've been around 6% for the last 30 to 45 days already. And I think this is great, and it should continue to lower down as the year goes by. I don't think by the end of the year we're going to be at like 5 or lower. I do think we're probably going to end the year in the mid 5s, upper 5s, and it'll just hover around there because you're going to have that transition of that new Fed chairman coming in, and then the whole battle between the Fed chairman, the fact that they're supposed to be independent from the White House, and you're going to have all this drama go on. And I think the rates are just going to either get cut once or twice. But however, the mortgage rates themselves will probably stay right around 5.5, maybe 5.25 at the low end. We might see that in August, September time, but I think we're going to be around the mid 5s throughout the year. And again, so far, this is a great rate compared to the last year and the year before that. So we might even see a big refinance boom this year, where people that have 7%, 7.5%, 8% interest rates, they're going to be refinancing into newer homes. Now, what this also tells us is that buyer demand and seller demand is going to increase as well in terms of real estate. So buyer demand this week, pending home sales climbed steadily, reaching 56,252 with consistent week over week and year over year increase. So we see that buyers have returned to the market. Not like a crazy amount increase, but they have returned. And so homeowners, the properties should not be sitting on the market. They're priced properly. they shouldn't be sitting on the market for too long. However, if you've priced it above market just because you think that's what your house is worth and you don't want to listen to a professional and you want to list it whatever price you think is right, then your property is going to sit on the market, double, triple the average time. Mortgage applications rose 5% week over week and 18% from the same time last year. So people that are going into contract or that are now in the mortgage process. So buyers that are just the buyer demand, as in that's the traffic that's coming, that increased year over year. But now we're moving from the buyers when they get into a mortgage or they apply for a mortgage, those applications have actually gone up by another 5%, meaning that buyers are very serious when they find a property and they're going forward and they're actually going in for a mortgage. And then historically, based on as the rate approaches 6%, we've seen demand, again, like I went over it, we've seen demand go up. And on the other side, we are actually seeing sellers with the inventory coming up as well. So a lot of sellers are getting more comfortable with the interest rate. So even though they might have locked in 3%, 4%, 5% during the COVID era with those rates, now we're seeing sellers open up to whether they're downsizing, they want to get a bigger house, they want to move. We're seeing sellers slowly open up and bring their houses to market with those 3% rates and give them up and exchange them for another home. Most of it is due to the equity because they realize, oh, we've built so much equity in this home over the last 3 years with the market increasing. Let's tap into that equity. We'll, instead of going and doing 20% down or taking a 5% down loan, we'll increase our down payment to 30%, 40% into the next home. So this way it brings our mortgage payment lower. And sellers are also deciding to take 15-year mortgages rather than 30, which will then balance out in the amortization schedule. It'll balance out their principal and interest payments. So this way they can also pay down their house much, much faster. Prices remain stable so far. We are median house prices at $419,900. We began last year at 421. I'll do another video with a 2025 recap, and I did make some predictions in the beginning of 2025. That's in my 2024 video, and I'll bring those back up and we'll see if I was right, was I wrong, and I'll make my predictions for this year as well. So stay tuned for that video as well. But however, average price across America stayed relatively flat and around $419,900 for a house. And market conditions right now are just ticking up slowly. We're not at a rapid increase where we're seeing, now again, this is talking relatively across the United States. However, there's pockets of counties and areas where the market is still super strong and there's multiple offer situations still going on. Then we have certain markets where it's completely destroyed and prices have dropped 30 to 40% from their peak on on prices. So, and again, I call that artificial increase. Those prices only went up due to demand of remote work and the fact that those were cheap houses at $200K from somebody that's living in the city area going to suburban, and they're used to $600-700K homes, and now they found homes for $200. They're working remote, and that's where that influx went. And artificially, those prices had gone up double, triple the price. Now they're coming back down to earth. They're relaxing. So we're seeing that happen across the nation in multiple different areas, and we're going to see throughout this year, we're going to continue to see the demand of buyers increase, as well as seller listings come to market. And it's very important that we have a balanced market, not a one-sided market, because when we have a one-sided market is when you enter into these home prices ridiculously going up. If it's buyer demand, or if we see a seller demand and we see prices come down, which we would like to see prices come down. However, because of the interest rates that people have locked in, the terms that they have, it's very, very difficult for the foreseeable future that we see a seller's market, a buyer's market open up in a lot of different places. Just because sellers have so much leverage at this point, inventory is still at historic lows. They're not, increasing at the levels that the market would need in order for it to be a more balanced market. So we're not seeing that happen. And I don't think we're going to see that happen this year either. But that's where we are this week. That's what the interest rates are. If you'd like to know about some other topic that you want me to talk about next week, please leave a comment below. Let me know what do you think? Do you think the federal government should have cut the rates, or should they have increased the rates, or do you think they made a good choice in just keeping the rates steady? Leave your comments below. Until then, I'll see you guys in the next one. Thank you for watching.